December 20th, 2025. Silver just hit $67.40 per ounce. That's a 127% gain in 12 months. While you were sleeping, a narrative went viral across financial media. BlackRock's $13.46 trillion in assets could flood the silver market overnight. YouTube with the videos racked up millions of views. Social media exploded with claims of secret SEC filings, predictions of $100 silver within weeks. Here's what they're not telling you. The flood isn't coming. It's already here, but not the way they said it would be. Welcome to the Wealth Timeline, where money, power, and history quietly shape the world around us. You have 72 hours to understand what's actually happening in silver. Not the hype, not the clickbait. The mechanism behind the biggest commodity squeeze of 2025. Because while everyone's watching for a tidal wave, the real story is unfolding in the shadows. Paper silver is collapsing. Physical silver is vanishing. And the institutions aren't flooding in overnight. They're bleeding in slowly, methodically, invisibly. This is the story they missed. Let me take you back to 1979. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, decided silver was undervalued. They started buying physical silver, futures contracts by the truckload. January 1980, silver hit $50 per ounce. The Hunt brothers controlled an estimated 100 million ounces of physical silver. They held 90% of all deliverable COMEX inventory. The market was cornered. Then the empire struck back. COMEX changed the rules overnight. They implemented Silver Rule 7, limiting speculative positions and forcing liquidation-only trading. The Chicago Board of Trade followed. Margin requirements skyrocketed from 10% to 100%. March 27th, 1980, Silver Thursday. Silver crashed from $50 to $10.80 in a single day. The Hunt brothers lost over $1 billion. They filed for bankruptcy. The market was saved, or so the narrative goes. Here's what matters. When physical accumulation threatens paper market stability, regulators intervene. They change the rules. They protect the system. Fast forward to January 2024, BlackRock launches a Bitcoin ETF. Within 11 months, $36 billion floods in. Bitcoin's market cap surges from $800 billion to over $2 trillion. Institutional money doesn't trickle. It stampedes when the door opens. Silver's investable market, $50 to $70 billion total. Do the math. If Bitcoin's ETF pattern repeats, even partially, silver's tiny market can't absorb that capital without breaking. But here's the twist. BlackRock isn't planning what everyone thinks they're planning. Let's cut through the noise. BlackRock manages $13.46 trillion in assets as of Q3 or 2025. That number went viral, rounded down to $10 trillion in headlines, sensationalized into BlackRock could dump trillions into silver. False. BlackRock doesn't own that money. They manage it. Pension funds, sovereign wealth funds, retail investors. BlackRock earns fees for stewardship. They don't deploy proprietary capital into niche commodity plays. Here's what they actually do in silver. BlackRock sponsors the iShares Silver Trust, ticker SLV, the world's largest silver ETF. As of December 20th, 2025, SLV holds 516.5 million ounces of physical silver. That's approximately $34.6 billion at current prices. 569.55 million shares outstanding. When investors buy SLV shares, the trust purchases physical silver. When they sell, silver gets released. Simple mechanism. Now here's the critical detail everyone missed. BlackRock itself owns under 10,000 shares of SLV. Minimal exposure. They're the manager, not the buyer. Viral YouTube videos claimed BlackRock filed an S1 for a new physical silver ETF in November 2024. They claimed $2.1 billion dumped into silver before Federal Reserve meetings. They predicted $70 to $100 silver by year end. I checked the SEC Edgar database. No such S1 filing exists. SLV has operated since 2006. The $2.1 billion figure? Likely misattributed net creations from broad investor activity across 2025, not BlackRock's direct action. The narrative is false, but the underlying pressure is real. Here's why. Silver's supply-demand fundamentals have entered crisis territory. The Silver Institute reports 2024 mine production at 819.7 million ounces. Recycling added 193.9 million ounces. Total supply, 1.014 billion ounces. Demand, 1.16 billion ounces. That's a deficit of 146 million ounces. The fifth consecutive year of shortfalls, cumulative deficit since 2021, over 800 million ounces. Where's the demand coming from? Industrial use hit record highs, 650 million ounces projected for 2025. Photovoltaics, solar panels, consumed 250 million ounces alone. Electric vehicles, 90 million ounces. AI data centers, 5G infrastructure, electronics, 65 million ounces. Green energy transitions make silver demand price insensitive. You can't substitute silver in solar cells without efficiency collapse. Jewelry demand, 208.7 million ounces, up 3%. India and Thailand driving growth. Physical investment in bars and coins, declining. But ETF inflows are compensating. Global ETF markets saw record inflows in 2025. Commodities benefiting from inflation hedges. Now the supply side gets worse. 75% of silver is a byproduct of mining copper, lead, and zinc. When base metal prices fall, silver production falls. Regardless of silver's price, mine output has declined 2% since 2020. Top producers, Mexico, China, and Peru, face operational constraints. Inventories are bleeding. COMEX warehouses, 113 million ounces. Multi-year lows. London vault strained. Shanghai struggling. Silver lease rates spiked to 3% annualized, a sign of physical tightness. December 10th, 2025, the Federal Reserve cut rates to 3.50, 3.75%. Not the pause everyone expected. A cut that weakened the dollar, strengthened commodity prices. Silver surged. The paper market, COMEX futures, options, derivatives, trades 200 times more silver than actually exists for delivery. It's a leverage game. Short positions dominate. Banks hedge. Speculators bet. But physical silver? It's disappearing. This is the real story, not BlackRock's mythical flood, the slow, grinding, structural squeeze that nobody's talking about. So what happens next? Let me give you 3 scenarios. Not predictions, analysis. Pathways based on mechanics, history, and incentives. Scenario 1, the gradual institutional creep, 60% probability. Institutional allocations don't happen overnight. They happen in quarterly rebalancing. Pension funds shift 0.1% of assets into commodities. Sovereign wealth funds add silver exposure through ETFs. If just 0.1% of global pension assets, $50 trillion total, rotated into silver, that's $50 billion. The entire investable silver market. Timeline, 12 to 24 months, prices drift higher. $70 by Q1 2026, $80 by mid-2026. Volatility increases, dips to $58, $62 on Fed commentary. Rebounds on supply news. Physical premiums widen. Retail buyers pay 15-20% over spot for coins and bars. Delivery delays extend to 8 to 12 weeks. COMEX inventories fall below 100 million ounces by March 2026. No explosion. Just relentless upward pressure. The institutions aren't flooding, they're wading in. Slowly, quietly, methodically. Scenario 2, the regulatory intervention, 25% probability. History repeats. Silver crosses $75. Short positions on COMEX reach critical mass. A major bank faces margin calls. Rumors circulate about delivery defaults. COMEX steps in. They raise margin requirements, limit speculative positions, force liquidation-only trading for certain contract months. The playbook from 1980, silver crashes 20-30% in days, $75 to $55. Media calls it a bubble bursting. Retail investors panic sell. Institutions buy the dip. Physical market decouples. Coins and bars trade at 30 to 40% premiums over paper spot prices. Two-tier market emerges. Paper silver collapses, while physical climbs like a shadow market rising unseen. By Q3 2026, the physical market reasserts dominance. Prices recover to $85, $90. But trust in paper silver is shattered. Delivery becomes king. Scenario 3, the supply shock event, 15% probability. A major mine collapse, Peru or Mexico. Geopolitical disruption in China. A refinery fire. Natural disaster. Overnight, 50, 80 million ounces of annual supply vanish. Industrial buyers panic. Solar manufacturers, EV producers scramble for contracts. Bidding wars erupt. Silver spikes to $90 in 72 hours. $100 within 2 weeks. COMEX trading halts. Circuit breakers trigger. Emergency CFTC meetings. Governments invoke Defense Production Act-style measures. Strategic reserves discussed. Export restrictions implemented by producing nations. Physical silver becomes unobtainable at any price for retail. Only industrial contracts honored. Black market premiums hit 50-70% over spot. This scenario is low probability, but not zero. One disruption in a supply chain already stretched to breaking. Now let's talk about the narrative. Why did BlackRock flooding silver go viral? Because it's simple, it's dramatic. It has a villain, big money institutions. It has a hero, retail investors who get in early. It taps into David versus Goliath psychology. YouTube channels need views. Titles like BlackRock's $10 trillion about to flood silver drive clicks. The algorithm rewards urgency. Timestamps promise revelations. Comment sections fill with confirmation bias. But here's the mechanism behind the hype. Silver has genuine supply constraints. Prices genuinely surged 127% in 2025. Those facts are real. But wrapping them in a false BlackRock narrative creates emotional urgency that obscures actual analysis. Coordinated? No. Opportunistic? Absolutely. Retail investors see the hype, buy physical silver or SLV shares, driving real inflows, which then get cited as proof BlackRock is acting. Self-fulfilling prophecy through narrative momentum. Meanwhile, actual institutional money moves in darkness. Pension fund rebalancing reports come out quarterly. Sovereign wealth fund allocations aren't announced. Private equity commodity positions stay private. The empire doesn't telegraph its moves. When Hunt Brothers cornered silver in 1980, they accumulated for years before the market noticed. By the time the public knew, the trade was already crowded. Then, regulators changed the rules. Today's institutions learned that lesson. They don't corner. They gradually accumulate. They use ETFs, derivatives, synthetic exposure. They stay below reporting thresholds. They spread positions across jurisdictions. The media frames it as smart money versus dumb money, but the real division is informed versus reactionary. Here's what the media won't tell you. Physical silver shortages benefit institutional holders. If you already own 500 million ounces through an ETF structure and supply tightens, your position appreciates without adding capital. BlackRock doesn't need to flood silver. They just need to hold while the deficit compounds. The narrative is a distraction. The mechanism is patient capital meeting structural scarcity, and you're watching it unfold in real time. So what do you actually watch for? Not YouTube hype, not social media rumors, real signals, market mechanics, data points that precede price moves. Signal 1, COMEX inventory levels. Track registered silver ounces weekly, available at CME Group website. If inventories drop below 100 million ounces, physical tightness intensifies. Historical precedent, 2011 inventories fell to 103 million before silver hit $49. Signal 2, physical premiums. Monitor premiums on silver coins and bars above spot price. Check dealers like JM Bullion, APMEX, SD Bullion. Premiums above 15% indicate physical supply stress. Above 20% signals potential delivery delays. Above 30%, decoupling between paper and physical markets. Signal 3, silver lease rates. Available through Bloomberg or precious metals data services. Lease rates above 2% annualized indicate tight lending markets. Above 5% signals crisis conditions. December 2025 hit 3%, yellow flag. Signal 4, ETF flows, track SLV, SIVR, and PSLV, weekly inflows and outflows. Sustained inflows over 4 or 6 weeks indicate institutional positioning. Check iShares website for SLV updates. Outflows during price rises, profit taking, inflows during dips. Accumulation. Signal 5, margin requirement changes. COMEX publishes margin requirements for silver futures. Sudden increases indicate exchange concerns about volatility or default risk. Historical pattern. Margin hikes precede corrections or regulatory intervention. Signal 6, mining output reports. Silver Institute publishes annual World Silver Survey. Watch quarterly updates from major producers, Fresnillo, Pan American Silver, Kerr Mining. Production declines, compound supply deficits. Signal 7, industrial demand data. Solar panel installations, EV sales figures, data center construction. These drive real silver consumption. Growth in these sectors require sustained demand pressure. Now, scenario-based educational frameworks are not advice. If you're observing silver, understand the tools. Physical bullion, direct exposure, storage costs, premiums, liquidity constraints. ETFs like SLV, paper exposure, no storage, instant liquidity, counterparty risk. Mining stocks, leverage to silver price, operational risk, dividend potential. Futures options, high leverage, margin risk, expiration dates, sophisticated. Different scenarios favor different positions. Gradual institutional creep, ETFs and quality miners outperform. Regulatory intervention, physical decouples, premiums explode. Supply shock, physical becomes unobtainable, miners surge on production value. Watch margin requirements, watch premiums, watch inventories. The empire doesn't announce its moves, but it leaves footprints. And remember, this is educational analysis, not personal financial advice. I'm not your advisor. I'm showing you the map. You choose the path. December 20th, 2025. Silver at 67.40. The viral narrative says BlackRock's $10 trillion is about to flood the market overnight. The truth? BlackRock manages money. They don't flood markets. They shape them. But while everyone's watching for a tidal wave, the real story unfolds in the shadows. A 5-year supply deficit. 800 million ounces vanished. Industrial demand that can't be substituted. Inventories at multi-year lows. Institutional capital wading in, slowly, methodically, invisibly. The overnight flood is a myth. The gradual squeeze is reality. And you just learn to see the difference. 72 hours from now, another headline will go viral. Another prediction of imminent explosion or collapse. Another narrative designed to trigger emotion over analysis. But you'll know better. You'll watch the inventories, the premiums, the lease rates, the signals that actually matter. Because in markets like this, information is the only edge that lasts. The empire doesn't need to strike back this time. They never left. Stay alert. Stay informed. And remember, this is just the beginning of the shift. See you next time.